Return of capital. This is an alternative to purchase of own shares. Purchase of own shares is normally done when perhaps the relationship has gone a bit bad between the current existing shareholders, and one of the reasons that it's going to benefit the trade is because it would be better if that shareholder wasn't there and they were and they left, and then the existing shareholders and directors could take that company forward. So supposing you've got a company which you've ran for the last 10, 20, 30 years, you've built the value up in that company, and you don't want it to go anywhere, but what you do want to do is realise some of that value. And I'll just go to the next slide. Under the current rules, how would you get any value out of your company? Well, generally you'd pay yourself a dividend, and you'd pay rates of 25% or 31%, depending upon what your tax profile was, on those dividends. What you really want to do is get it under capital treatment and claim entrepreneurs relief. So how could you do that, but while still remaining a shareholder, still remaining carrying on trading, still remaining building up the value of that company, but just realising some of it under the capital route, not the income route, and the capital route because of entrepreneurs relief. So there is a method by which you can do this, and it's called return of capital. You literally return share capital value back to the shareholders. Okay? And that will be taxed under capital route. Hopefully you will qualify for entrepreneurs relief. You would do it if you didn't qualify for an entrepreneurs relief, as Parminder just pointed out, and you pay tax at 10% on the return of that value. What needs to have happened though is you need the trading company to have put a holding company on top, and the existing shareholders literally do a share for share exchange. So the shares they held in Tradeco, they now own in exactly the same proportions in Holding Co, and Holding Co now owns Trading Co 100%. So you could do that and then wait a bit of time, or in most cases share for share exchange happen all the time. Holding companies are put into group under reorganisations all the time, and for differing reasons. Quite a lot of the time it's done because you've got quite a lot of trading companies that are all standalone and you want to bring it all under one trading umbrella. It could be that you've got properties in your trading company and you want to get those properties out of that trading company so that they're not at risk of the trade going bad, and then properties having to be sold to pay your liquidators. You want them separate, so if the trade goes bad you've still got that property company separately, and people generally have holding companies that have then got the Tradeco as a subsidiary and the property company as a subsidiary. And if you've got that structure, that also helps for things like business property relief for inheritance tax purposes. And what you can actually do, if you meet all the conditions of the wholly and mainly test, you can then have the whole property group and the trading group completely exempt for IHT on death. The people have generally already done this and have holding companies. It's very common and done this share for share exchange anyway. It doesn't mean you can't then go on and do it, but it's normally been done in place previously. And what happens when you do that share for share exchange, even though you had 100 £1 shares to begin with and you've still got 100 £1 shares, but now in the holding company, at the point you do that share for share exchange, those shares are worth something. They're worth what that company is worth at that point that you do the share for share exchange. And what a return of capital allows you to do is it allows you to literally say, right, I'm going to sell 20 of my 100 shares back to the company. And I will do that at the value when it transfers on under that share for share exchange. Okay? And you get a reduction for what your shares actually cost you in the first place. So just suppose you bought them at par, £20, and your company is now, I don't know, worth 10 million. Just to keep the numbers easy. So now you're going to realise, when you did that share for share exchange, they were worth 2 million. So you've got 2 million less obviously your 20 quid. That's your gain for chargeable gains tax purposes. In entrepreneurs relief, you just got 2 million out basically at 10%, and not 2 million out at dividend rates of 31% basically, if you're getting 2 million out. We've got clients that are doing this. One of our clients does this annually. Realises their value annually and is using up their basically £10 million lifetime limit of entrepreneurs relief. We have gone to council, leading tax council, have got opinion on this. We do this on most ideas that we have to check that they're within the Companies Act, to check they're within the Corporations Act, transactions in securities and capital gains tax regime, and make sure we haven't missed anything within the legislation, and we do have opinion that supports this, and we are doing it. HMRC is obviously a very different HMRC to what it used to be. It's much more aggressive. They've now got powers under GAR, if you know what that is, the general anti-avoidance regulations. But we think we're well within it, and that's why we go to the Tax Council to make sure we can't be attacked under those rules, new rules that HMRC have now got. So definitely something to think about, because 10% compared to 25 and 31, if you have no intention of actually leaving your company or going anywhere, but you actually want to realise some of that value that you've built up over the last 10, 20 years, definitely a route to go down. And it is an alternative to purchase of own shares, which has got all of these, obviously, rules that you have to, and hoops that you have to jump through. And it creates a capital redemption reserve, and I don't think this route does.